One of the most popular fund strategies that retail investors are flocking to this year are covered call ETFs. So, are these option strategy ETFs investment traps, or are they essential components of an income investor's portfolio? Subscribe to the channel and join me today to find out if covered call funds are right for you, including some funds that I like right here in the red zone. A covered call fund is a fund that generates income by writing or selling call options, most of the time on underlying assets, and the ETF collects those premiums, which generate income. If you're new to options, Investopedia has a great series of articles to learn more, along with plenty of examples. Yields in these funds can be obnoxiously high for some, for example, in the Yield Max family of funds, and not quite as exciting as in the Amplify Fund family. Covered call funds sound like what a red zone or investor could be looking for, but are there any downsides? The criticisms against this as a fund strategy include first, lower price appreciation. Here are some of the more widely held S&P 500 covered call funds like JEPI from JP Morgan, SPYI from NEOS, and GPIX from Goldman Sachs. Looking at how these funds are performing this year, notice that JEPI is down in a year that the S&P 500 is up more than 15%, while SPYI is slightly above its starting price and GPIX, which is the newest fund, is about one third of the price appreciation of just holding the basic index. You might be thinking, I thought we generally don't care much about price appreciation when we are looking at income investments, and you would be correct, as long as it's not negative like JEPI when its underlying index is up over 15%. Instead, what we do care about is total return. If we keep these same three funds, we see an underperformance in total return of a few percentage points for GPIX and SPYI, while JEPI is barely positive for the year to date. The slight underperformance of SPYI and GPIX from a total return standpoint when compared to the index is not that bad and is a trade off that many income investors are willing to make, especially for the high yields. You might be thinking that JEPI is just a bad covered call fund, and you would be partially correct. However, notice if we go to the 3 year time horizon and take a look at SPYI, we can see the gap between its total return and the total return of the index widen as time goes on, and periods where that spread seems to happen more are periods of rapid recoveries like November 2023, early September 2024 after the yen carry trade scare, and after the tariff announcements earlier this year. The calls on these funds that are generating your income are capping your price appreciation upside. And you see that pretty clearly this year during one of the fastest market recoveries ever following the tariff announcements. Covered call funds are also generally thought of as limiting downside protection when it comes to comparisons against their index. However, if we look at the market's reaction to the tariff announcements in April again, we see from a price standpoint that our covered call funds actually did a little bit worse on the way down in their price declines and that their underlying index. So that limiting downside protection doesn't always hold true. At this point, you might still be thinking that this is irrelevant. We are all aware of these trade offs, and the income is what you're really after. I think that's fine if you can still keep up with inflation, but the next risk may not let you, as it will persist in many of these funds. And that risk that I've talked about a few times on this channel is net asset value erosion. In some of these funds, the fund seems to be just paying you back your initial investment dollars, causing its price to decline. The most egregious of these examples seems to come from the YieldMax family. ETFs picture here are ULTY with a trailing dividend yield of 123% and YMAX with a trailing dividend yield of 67%. Yields this high are obvious red flags, but even this price return chart won't scare off some of our income investors as when we look at total return, we actually see both funds beating the S&P 500 in an upward trending market. However, If you are retired, you actually need to spend the income your portfolio is producing rather than simply reinvesting all of your distributions just to protect the price of your assets. Also, as the price goes down, your yield could stay exactly the same. But remember that yield is a percentage of the price, not the actual dollars. In other words, your high yield of 15% may start out as a dollar per share and then decline in real dollar payout as the price of the fund declines. Finally, you might have noticed that when I showed you the few charts of these ETFs that I used, a 1 year time chart. And that's because most of these funds do not even have a 5 year track record, let alone decades where you can gauge performance of a big stock market decline like the great financial crisis or the general bad period of time that followed, like the lost decade. The only fund that did have a 5 year track record was JEPI, which was underwhelming. Despite these downsides, I do think that a select few covered call funds could be appropriate for, first, income investors with balanced portfolios. In my opinion, holding a portfolio of purely covered call funds or even one with a large allocation is a bad idea if you have a long time horizon due to the likely underperformance, even from a total return standpoint. Second, red zone investors who can reinvest 100% of their dividends because they are still fully employed and nearing retirement, and retirees who can commit to reinvest a small percentage of their dividends. Reinvesting a small percentage of dividends will likely be required for the vast majority of these funds to prevent your assets' NAV erosion and declining income as time goes on. So the question becomes, is there one of these covered call funds that limit the weaknesses of the overall strategy in general? Let's start by looking at a few of the fund companies themselves, as each has a prevailing strategy that generally applies to all of their funds. JP Morgan, either through JEPI or JEBQ, uses a synthetic out of the money covered call strategy and underperforms peers. Their fund's management style is also passive in nature, which you can tell by its lower expense ratio, and it doesn't seem to have a great track record for this category when compared to its peers. Goldman Sachs has newer fund offerings in JPIX and GPIQ, which are starting to create an interest like JEPI and JEBQ used to have a few years ago until their underperformance started to show. In the crowded S&P 500 and Nasdaq covered call space, it might be a good idea to wait for at least a couple of years of a track record that could have a few declines in them to see how this fund responds. NEOS is one of the more popular covered call fund families. What I do like about NEOS is that it provides access to alternative asset classes like gold, Bitcoin, and real estate in addition to the basic indices. If you're interested in specific sectors of the S&P 500, State Street recently launched a covered call fund family that holds the underlying sector ETF and writes calls on those. These are brand new, so it's difficult to judge them at all. Next up is Amplify. These seem to be the most conservative of the pack and therefore pay out the least. They write options on less of the portfolio than their peers and generally hold more conservative stocks in most of the portfolios. Many income investors who originally invested into a JEPI or NEOS S&P 500 index fund or NASDAQ index fund for the higher yields are transitioning back to funds like Devo or QDevo, which have held its value much better over time but pay out substantially less. Finally is YieldMax, and to be frank, I don't really care what strategy they're executing, as all this fund family seems to do is pay back your initial investment. So, how am I using covered call funds to generate income in my portfolio? In the income portion, I am allocating not only by sector or asset class, but also by investment vehicle. My overall goal here for the income portion of my portfolio is to generate an 8% yield, which in general is conservative enough to mitigate the downsides of some of these investment vehicles and sectors, but at the same time allow me to stop working before I can do something like claim Social Security. For covered call funds specifically, I've decided to allocate no more than 15% of my total portfolio to these funds. I'm currently giving a hard look at Devo and IDVO, as well as NEOS funds like IYRI, which is based on the real estate sector, BTCI, which is based on Bitcoin, and IAUI based on gold, as well as in State Street XLUI, which is based on the utility sector. So, what is your view on covered call funds? If you'd like me to do a deeper dive on any of these funds in a future episode, or even compare them against similar funds like I did against other funds in this episode, let me know by leaving a comment. As always, feel free also to leave a comment to the community to let them know which covered call funds you're invested in and why you chose those particular funds. Until then, I'll see you next time right here in the red zone.